the passive losses against your active income. Is that a true statement? Because somebody else denied that for me.
Yeah, so it's called an active participant in real estate. So passive loss offsets passive income. Passive losses are 469 C7, which is if you want to be a real estate professional and treat passive losses to become ordinary. If you are under $100,000 of adjusted gross income, you could write off 25,000. If you're between 100 and 150,000 of adjusted gross income, it starts to phase out. So it depends on your income of it as a taxpayer. So if you're an investor that's in a syndication, you're not going to be qualifying for this because you're making too much money, unless you're qualifying just on your asset base and you're not really making any money. But if you're an accredited investor, you're making.
This is the Real Estate Vibe Show, and I'm your host, Winky Loomba, a real estate investor. Today, I have a very special guest. I would say he's my friend now, Toby Mathis with me. Welcome, Toby.
Hey, thanks for having me.
So I'm going to tell you a little bit about Toby. Toby's a skilled tax attorney with 25 years of experience who helps successful investors save and make money. He's committed to sharing his knowledge and expertise through education, has helped thousands of clients nationwide. Toby's vast experience also includes investing in over 200 real estate projects in the US, and he's the author of award-winning publications. He's dedicated to helping investors and business owners protect and preserve their wealth while creating a legacy for future generations. So today we'll talk about how to optimize your business, maximizing tax benefits while minimizing legal risks. So before we get started, I'm going to ask you if you can tell us a little bit about your background, how did you get here, and also your expertise in business structuring and tax planning.
Yeah, thanks again. So I became an attorney, I think it was in 1997, been trying to make up for that fact ever since. But I became an attorney not to just be a typical attorney. I became an attorney because my mentor, who was a business owner, wanted myself and his son, and actually he went to law school too, but he was like, boy, these lawyers are screwing up our business. They would always tell him everything he couldn't do and not what he could do. And so he asked his son and I to go get our legal degrees. So I never really became an attorney just to go in there and act like Matlock or, go to court or anything like that. I became an attorney really so that I could be a more effective investor and business owner. And that's where I focus my attention, is on tax, asset protection, things that actually matter to the small business person and the small business investor. Legacy planning is a big component, and also business planning. It all kind of goes hand in hand and meshes together. And if you don't understand what's going on from a tax standpoint, it has a pretty big impact on your bottom line, the same way as if you don't understand what your risks are from an asset protection standpoint, somebody could take it all away. So we're always looking at it, trying to make sure that we're balancing. We call it the four-legged stool. You want to make sure that you have about even legs on the lawsuit, the tax, the business planning, and the legacy planning, so that you don't fall over. And they all will support that great platform of your investing if you allow it.
That's good. I like that. So can you explain a little bit the concept of business planning or structuring, and why it's so important?
Yeah, so I'll use an example of a client that reached out that was having trouble selling it was a commercial building, and we kind of figured it out pretty quick, pretty early on what was going on. And what it was their accountant had set them up through a disregarded LLC, meaning that the commercial building didn't have to file its own tax return. It was going on to somebody's Schedule E on their 1040. So it was just going on to their personal tax return. So I won't get too technical. And the problem is when you're a buyer and you're trying to underwrite a loan, you need a tax return of that particular property, which now doesn't exist. And so here you had somebody who had an accountant who was doing something completely appropriate. Like I would say, yeah, you know what, in most situations, it's okay to have a disregarded LLC. It doesn't show up on your tax return. You have one less tax return you have to file. This is great. But when you're doing commercial property, if you understand commercial underwriting, you would know this is going to be catastrophic for your ability to sell it. And that's exactly what was happening here. It was just as easy as getting them to file a partnership. In their case, it was husband and wife, and it could be done. And once the sellers now are underwriting, and we actually had multiple deals fall out for these folks, not us, but before they came to us, they'd had 2 deals collapse, and we just believed that it was because of the way that they looked and the way that they were filing their taxes and maintaining their books. It just didn't look like a separate endeavor. And so we made it look like a separate endeavor, and boom, they're able to sell it much quicker that way. And a lot of it is because you have to understand how underwriting works. And it could be as simple as this. This is kind of a funky one, but when you look at Freddie and Fannie and their underwriting criteria, they'll use 100% of your income that's on page 2 of a Schedule E, but 70% of your income on page 1. And you look at it going, well, what's the difference? Well, the difference is if I'm getting a K1 from a partnership or an S Corp, I'd probably be on page 2. If it's just flowing onto my return, it's going to be on page 1. I could be having difficulty underwriting even for loans on real estate simply because of the way that I've chosen to set up my tax structure. And that's why we look at the business planning, the tax structure, asset protection, estate planning all together, because if one becomes a dominant force, like let's say that I use asset protection and I love using anonymity. So I love using Wyoming entities. I love to make it really difficult for someone to figure out what I have.
Mhm.
But if I need to bank that entity, if I need to get a loan on that entity, that's going to be a hurdle, right? So the business planning starts to get at odds with the asset protection. And so if you go to the asset protection planner, they'll set you up with something that you may never be able to get a loan ever again, makes it difficult to grow and actually cost you money. If you go to the business planner, they may leave you completely exposed. You may be, you may look in set yourself up in a completely different way that causes you a ton of exposure. The trick is finding the right alignment between those things. And we call it the delicate dance, is making sure that you look the way that you need to look for securing credit or loans. If that's the way you're growing, make sure you look that way, but at the same time, not leaving yourself exposed for one bad event to cause you to lose everything you have. So that's where it really comes in when you're planning. That's why we call it the 4-legged stool, is if you are ignoring one of those legs, that's where you're going to fall over, right? You're going to be out of balance. You're going to have a difficult time and you don't realize it. I'll use this as my final example, is if you work your butt off and you make a great business and then you screw up your estate planning and you end up in probate for 3 years and your kids end up tearing each other apart over the, and the business is gone, everything has to be sold or liquidated, everything you worked for, boosh, gone, because you didn't pay attention to that leg of the stool. You may have been great at everything else, but it was still all for naught because you had a lack of balance. So we just look at it very differently. I look at it very differently. I'm always trying to get a glean of what's your intent, what's your exit, what's your, like, I'm a tax guy, so I could get just about anybody down to 0. Like, it's just a matter of how much you're willing to put into it. We can get your taxes. We can eliminate tax. But why would you? It's going to make it really tough to bank. You're not going to be able to get a home loan if you don't have any income, right? You're not going to be able to get portfolio loans on a business if you don't have personal credit, for example.
That's true.
All these things interplay with each other. There's not a one size fits all on that. You have to have somebody who's actually well versed. And what I found is that a lot of the practitioners out there are not. They've learned one key on that keyboard. They don't know how to play a chord to save their life. And it's really important that you find people that actually can play chords.
That's good. So I'm going to talk to you about the 4 legs of the stool, all 4 legs. But before that, I'm going to ask you a follow-up question, because most syndications, the way they're set up is the structure is LLC, which is pass-through entity, right? Yes. So that's how you give the K1s to your investors, which are the LPs. So how that's different from the disengaged entity, or is one of the same?
Oh, so a disregarded entity just
Or
means,
disregarded, sorry. Yeah.
yeah, disregarded means that we ignore it for tax purposes. And that only works when it's one owner, or if it's a husband and wife in a community property state, or if you have a living trust, one trustee is the owner. You create a entity that for asset protection is effective, but the federal government ignores it and just looks to your tax return. So if I set up a disregarded LLC, it means to the IRS, they don't expect a tax return on it. They expect it to go on to the owner's tax return. In a syndication, it's almost always a partnership, right? You have the managing partners, the folks running the syndication. Usually they're getting a piece of the pie. Usually, you know, maybe it's 20% or something. And then there's the 80% of all the rest of the class B, class A owners, depending on how you have it set up. But there's partners and they're getting a K1. So the LLC does not exist to the IRS. We tell the IRS how we want it to be treated. So for purposes of the IRS, they see a partnership and they expect a partnership return once a year called a 1065.
Mm-hmm.
The 1065 is an informational return, and it says, here's all the individual partners and here's their portion of the profit or the loss. And they give you a K1 that represents those numbers, and you put that on your tax return. If you want to get audited, just forget to put that on your return, right? Have somebody report a K1 to you, and then don't have it on your on your 1040. You might get that knock on your door or the letter in the mail. What I see with syndications, this is the big one. Syndications can be huge tax boons right now.
Mm-hmm.
You're into alternative energy, like you're doing solar farms, or you're putting solar up on a building and things like that. You can get tax credits, and then you could accelerate the depreciation on it. You can get a building, let's say multifamily or commercial building, and you can do a cost segregation on it and break it down into its 5, 7, 15-year property. And what this means is I'm writing it off really fast. And then under 168K, I can bonus depreciate that, and I can take big chunk of that in the first year. So if I bought a property in 2023, for example, I can write off 80% of the value of my 5, 7, and 15-year property. That's land improvements, the parking lot, planting stuff, cabinets, the carpeting, anything that's removable flooring, your linoleum, all that fun stuff. I get to write off 80% of it right away, even if I financed it. So you go into a building, you raise $1 million, you buy a $5 million building, and you get a $1.2 million deduction, right? It's like, wait a second, I get more deduction than I put in. Yep. But for most of those folks, it's passive because they're not considered a real estate professional, and they end up with passive loss. And they're like, what do I do with this thing? All is not lost. You just carry it forward, and it wipes out any other passive income you have. There's two types: rental income is passive income, and businesses that you don't materially participate in. Like if you're a silent owner in a restaurant, that would be passive also. But if you don't use it, you just carry it forward. You got to keep track of it. And eventually that gets released. So in a syndication, if the syndicator sells the property eventually, let's say I do a multifamily, I have a 5-year hold, I had all this loss that I couldn't use, and I carried it forward. The day that we sell it and get rid of that asset is the day that that loss gets released, and it's going to offset my any of the income that's generated, but it's going to do something else that's even more important. It's going to become ordinary loss that I can use against my other income once I release it. It's kind of interesting. And the other fun thing is when you're in syndications, and this is something that I'm sure that your viewers and listeners do not know. I can almost guarantee, I bet you 1% may know this. When you are in a syndication and you have capital gain, it maintains its nature as passive if you were a passive investor. So you actually have passive capital gains when you exit a syndication. So if you have all this capital gain, you could go into another syndication and get passive loss that offsets that passive capital gain, and boom, we call that the lazy man's 1031. You don't have to pay tax on it. It's just going to wipe it.
Yeah. So basically you're saying is when you have the long-term capital gain, and at the same time, you've been just saving all your tax credits because those were all the passive credits that you got that you cannot write against your active income. But year 5, you're able to use that as ordinary losses that you can write off against your active income, which could be in 1 year, or can you do it in the multiple years? Can you carry some of the residual to the next year or no?
Yeah, you still carry forward any of your losses. You don't lose them.
Or you can still carry them even though the deal is closed. Because I'm thinking about that, because when the deal is closed, you have, let's say, huge check. Let's say if you said 2x returns for 100,000, you went to 200,000, you got $100,000 capital gain. But benefit will be at this point is just taking that and investing in another deal. So you have another K1 to offset that. So, but the existing K1 losses that you have, how do you best use those in your favor so that you're not paying taxes and at the same time you're making money kind of on the side?
So the loss does become ordinary when you have those passive losses. Now, generally they're offsetting the profit that's being generated. So let's say you 2x'd realistically, what I see is most people are using their passive losses against their other passive income. So when I see syndicators, they have other rental income, they have other businesses and they're using that up. But let's just say you had some extra, it would be released when you sold on that particular property. So it would keep you from having to pay a lot of, as much gain. And then the rest of that gain is still passive. And so if you want to offset and pay no tax on exiting that syndication where you had a 2x return, go get into another syndication. And now you're going to have a loss that you'll be able to use because I have passive income. Again, a lot of accounts are going to go, that's capital gain. That's not passive gain. It maintains its nature. If it was passive activity and you have capital gains from it, it's going to be passive capital gains. And yeah, your passive losses will offset it.
But the losses at the exit becomes active losses that can go against your active income, which is super awesome because it's beneficial for both ends. You can make money on both sides, kind of save money more than making money.
Yeah.
So,
it really is up to you to determine what am I going to use my losses against. And so you're in the driver's seat. You have the restriction of, hey, if it's passive, but you want to know another way to unlock it is to become a real estate professional. And even if you're a passive syndicator, the designation as a real estate professional is you as an individual. And if you're filing a joint return, it's both spouses. So I can be involved in syndications, generating massive amounts of loss, and it's no longer passive if I can qualify as a real estate professional. Now, if I am a limited partner, it's a little bit of a tough road because I have to be a material participant at 500 hours. So I got to spend a lot of time on real estate. My spouse and I, you add up our time, you have to meet 500 hours. But if you're just a real estate professional and you're just investing in syndications as a limited liability company and you're just one of the partners, then it's actually a lot easier. You could qualify with as little as 100 hours or no hours if you're managing everything. But if you were in a syndication, it'd definitely be the 100 hours. That's not horrifically hard to do. That's not a lot of time to be spending on an activity. Treat it as non-passive.
Let me ask you another question. Somebody told me, actually, one of the CPA's attorney told me that you're able to write off $25,000 in 1 year, the passive losses against your active income. Is that a true statement? Because somebody else denied that for me.
Yeah, so it's called an active participant in real estate. So passive loss offsets passive income. Passive losses are 469 C7, which is if you want to be a real estate professional and treat passive losses to become ordinary. If you are under $100,000 of adjusted gross income, you could write off 25,000. If you're between 100 and 150,000 of adjusted gross income, it starts to phase out. So it depends on your income of it as a taxpayer. So if you're an investor that's in a syndication, you're not going to be qualifying for this because you're making too much money, unless you're qualifying just on your asset base and you're not really making any money. But if you're an accredited investor, you're making 250, 300 a year, you can qualify. So there's a good chance that most of those folks are never going to qualify. But if you're somebody who's making 100,000, 110, 120,000, yeah, you could write off a chunk of it as long as you're an active participant. And to be an active participant in real estate just means that you manage the manager. That's it. Am I managing that manager? Am I making overall decisions? And if the answer is yes, then you could write off up to $25,000 of passive loss against your other income sources. So your ordinary, your W-2 income, for example, you could write off up to 25,000.
So what is the definition of managing the manager? Because passive investor is passive, right? They just get their monthly reports or quarterly distributions. They do not have any active participation in the deal. So if you can shed some light on that.
Yeah. So usually when you're going to qualify as an active participant in real estate, and I'm not looking at the code, so I'm just going to go off of the memory, is you ultimately have the decision-making ability on that property. You're probably not going to have it on a syndication, right? But you're going to have it on some of your other activities. And as long as you qualify as as I am managing those folks, like I have the ultimate say. For example, if I have property managers, I would qualify. On the syndication, I don't think it's a test. I won't speak out of turn. I'd have to look at it to see whether or not there's a nuance there. But generally speaking, if you are treating all your activities as ones, we call them aggregating your rental activities, then as long as you met the test on one, you meet the test on all. There's a little bit of a downside to doing aggregations unless you're trying to be a real estate professional. And that is that if I am aggregating all my rental activities as one activity, which means I treat my syndications and my rental properties all as one activity, then I lose the ability to release those losses when I dispose of a property, because I'd have to dispose of all of the activity to make it, or substantially all of that activity to release those losses. So without getting too far into the weeds, you could probably get there, but you might have to aggregate it if you're doing syndications.
Interesting. So there is a recapture event happens too when you do the cost segregation or the bonus depreciation. How does that affect the limited partners?
So it's interesting. So when you're doing a cost segregation, what we're doing is breaking the building into its 1245 and 1250 components. 1245s are the personal property, and the 1250 is the structure. And so what I'm doing is I'm saying, here's the carpet, here's the cabinet, here's the driveway, here's the fence, here's the shrubs. They all have useful lives. According to the IRS at different levels. So it might be 5-year property, for example, for carpeting. It might be 15-year property for a driveway. Now I can write it off even faster because under bonus depreciation, any item that's 20 years or less, I can write off 80% of it this year. If you put it at property and service in prior years, it could be up to 100%, which means I get to take a huge deduction. Now, if I sell that property later, most of us are used to recapture. If it's the building recapture, so it's the 1250, so it's the structure itself, you recapture that at your ordinary bracket maxed out at 25%. Most people just say 25% because, again, you're dealing with credit investors who are making a lot of money. It's 25%. The other type of property, the personal property, if it's beyond its useful life, there's no recapture. It's just treated as capital gains. So I'll give you an example. I buy an apartment complex, I cost seg it, I write off all the carpeting, I held it for 5 years, I sold it. The useful life of that property is done of the carpeting. The carpeting has zero value. So there's no recapture, none, zilch. If I look at the cabinets, it might be 5-year property or 7-year property. Right. So I might have a small amount of recapture, and that's recaptured at my ordinary bracket. There's no 25% cap. 15-year property. Let's say I wrote off a third of that driveway, right? I still have 2/3 of it left, right? That might be treated as ordinary income. So you start kind of going down these paths and you realize, oh man, it's about as clear as mud, right? When you're breaking these things, there's different recapture rules. Just hire a cost seg company, and the cost segregation company, that's what they do. what's interesting, Vicky. You may actually like this. So I have done deals where it was advantageous to do the cost segregation after the property was sold. And I'm thinking about one case in particular. They purchased the property for 2.5. They sold it for 3.3 5 years later. They had not done a cost segregation. They came to us. The cost seg company, because you can go back to last year, like we're sitting in 2023, we could actually go and do a cost seg for 2022 all the way up until the filing deadline plus extensions. So like we could be doing cost segs for last year and getting huge amounts of depreciation. Well, if you sold the property, you think it's a done deal. Nope, I can still do a cost seg on a property. So somebody sold a property last year. They're looking at their tax bill. They're like, oh man, in this case, the tax was right around $280,000 was the recapture and the capital gains. We did the cost seg and it lowered it to 212. And so you were able to look at it and go, okay, all we have to do is get access to the building. As long as an engineer can get in there and do the cost seg, we're good. And people have no idea this even exists. And so you're looking at it, you're like, wow, somebody's like, hey, is there anything I can do here? I didn't 1031 exchange it. I don't want to do a qualified opportunity zone. What do I do here? And you look at it, well, we could always look at a cost seg on this. This looks like a lot of that property was improvement. You might find that it's advantageous for you to reclassify it and that way you're not paying recapture on property that doesn't have any value. And sure enough, cost of doing something like that might have been less than $10,000 or something like that. Like it's a lot. It's a big bang for your buck, and people do not realize that they actually have that option.
Interesting. So what is the time frame once you exit the property? How long or what time period you have to go back and do the cost seg so that you can use some benefits there?
Yeah. So when you're doing a cost segregation, you're making an election, a change of accounting election, which can be done all the way up until the taxpayer files their tax return plus extensions. So if it's a partnership, you're looking at September. If it's your property individually, you're looking at October. Go back for last year. So let's say I sold a property in January of 2022, I could still go back and cost seg that property. Let's say I bought a property 3 years ago and you're just hearing this concept and you're like, what's this crazy lawyer talking about that I can get this massive deduction? I did not know. Have I lost it? No, you can actually make a change of accounting, which this is what's so interesting. When you make a change of accounting election, I think it's a 3115. That's the form, but it literally says you're going from a disallowed version, so an impermissible method, to a permissible method. You are literally changing from an impermissible method, which is the, hey, I'm writing everything off over 27 and a half years or over 39 years, and you're changing it to the permissible method, which is I'm classifying each type of asset. This allows us to use the longer period of time because it's not in our best interest. We're basically giving the government a tax-free loan when you don't take a deduction for things that you purchased. You're like, hey, I don't want that deduction. I like paying tax on things like, on the money that I make, because you literally could just offset it if you did the cost seg. Even people that are just have little single family residences and they're making cash flow. Maybe you're making $20,000 a year with a few properties or a couple properties, whatever it is, but you have positive income. You could eliminate that quickly with a cost seg just by accelerating some of the depreciation, but break out the property. It might be I could cost seg one property. I could cost seg two. I could cost seg them all. I usually pick one or two a year in my portfolio, or, I think you mentioned we have over 200 individual properties, but we have apartment complexes and warehouses and some commercial buildings, things like that. And we just usually pick, hey, are we going to have income? Like as soon as we see, oh, shoot, this year we have passive income. I'm not a real estate professional because I don't meet the test. It's 750 hours and more than 50% of your work life is being devoted towards a real estate trader business. But so I don't qualify, but I can still use that passive loss to offset my rents and my other passive income. So I look at it and go, let's say I had 200,000 that was going to hit my return. I can do one cost seg and wipe that out. We're literally doing it. We're in the process of it now. We're going to cost seg 2 of our apartment buildings because we had a whole bunch of passive income this last year. And it's like, hey, you know what? I can wipe that thing out as simple as doing 1 or 2 of the cost segs. And then, and if you create a big loss, you don't lose it. You just carry it forward, but you can be very strategic. You don't have to do all your properties. You could do 1 a year. You could do 2 a year. You could go back and grab one that you bought in, let's say you bought a property in 2020 and you're hearing this and you're like, gosh, Toby, I wish I'd done that cost seg. You can still do it. And you're going to get the 100% bonus depreciation because the property was put in service in 2020. And in 2020, it was 100% bonus depreciation. It doesn't matter what.
Yeah. Oh my God. Backtrack. Awesome.
Absolutely. Get a big.
Wow. That's such an interesting concept. So one thing comes to my mind. You say you can do the cost seg after exiting the property. So how would that work? Let's say you exit the property, you say, okay, I'm gonna do kind of retro thing and I wanted to do the cost seg now because I'm gonna offset some of the capital gains. And here I bought the same property from you and I'm trying to do the cost seg first year so I can take the most tax benefits first year. Is the same property being depreciated twice? Can you shed some light on that? How does that work?
Yeah, so when you've exited the property, you've already depreciated it. What we're doing is changing the method of accounting to treat the personal property as personal property and the structural property as structural. If you leave it as a default, it's all going to be structural. It's all going to be that 27.5 year or 39 year property. So when I am going back, I sold a property, I'm changing my method of accounting to treat it as though I sold personal property and structural property. And if I do that, I might save myself some tax because personal property, if I've depreciated it, has no value and it's beyond its useful life. It's a zero, it's capital gains as opposed to recapture. And at a big enough number, that starts to really add up. And so in the case I mentioned, it was, close to $80,000. It was actually, right around $80,000. So I would rather do that. It cost me 10 it's 10 grand or whatever it is to save 70 or save 80. I'll take that action. 7x return. I'll take that. But yeah, so you're not actually redepreciating it or doing anything else. You're basically saying to the IRS, hey, I was going to just write all this off as in this case, it was 39 years. But I think I'm going to change it to 5, 7, 15, and 39 years. And I'm going to tell you what each portion is. And that's what you're really supposed to be doing from day one. That's the permissible method. The impermissible method is to treat it all as 39-year property. If you have a single family, to treat it all as 27.5-year property. You're not supposed to do that. You're literally, they let you do it because it makes the Treasury more money. They let you do it because it's not in your best interest, but technically you're supposed to be writing things off over their useful life. You're supposed to properly account for these things. Most people don't because cost segs, they used to be really expensive. Now they're coming down. Typical house, if you're doing single families, a typical house might be, 2,500. Typical apartment building, is going to be over 10 grand or 10,000 or more. Mobile home parks, manufactured home parks, where you have a lot of land improvement, RV parks, self-storage, you're going to be able to write off such a huge chunk of that property because most of it's improvement. We've seen cases where a property was bought for 1.2. The first year deduction was $900,000. Yep. So they put
that could happen. But the thing is, you said one thing very interesting. When you exit the property and you're trying to do the cost seg at that point, you said you write off the deductions as personal property. So what is going to be the definition of personal property for a commercial real estate? Because I'm talking about the syndications over here. So I need to understand that. How would you do that, or how you can classify it as a personal property?
Yeah, well, you have an engineer that's looking at it and saying, is this a removable item? Is this something that's part of the structure to where it can't be removed? But if it's removable, it can be taken off. So like your cabinets, blinds, your carpeting, your linoleums, things like that, specialty electric, even specialty plumbing, all those things that can be removed from a unit. Think of doing a build out, almost all that's removable, right?
Mhm.
All of that should be depreciated at a much quicker pace than 39 years, so like just think about if I put in a kitchen, right? I'm writing off those appliances in 5 years. I'm writing off the cabinets in 5 or 7 years. I'm writing off everything much faster than 27 and a half years. If it's a residential, if it's a commercial, it's much faster than 39 years. In either case, I'm just telling the IRS, this is what that is. You just have to have a what they call cost segregation study, which is I have a group that's all they do. It's a bunch of engineers and accountants. All they do is break down properties for the purposes of doing the cost segs, but also because you get tax credits if you're building new properties or putting something and making it more energy efficient. If you're doing rehabs, they might be doing R&D credits. There's all these little niches out there in the accounting world, but the most effective for syndications is always going to be that cost seg. And then deciding whether or not you want to use bonus depreciation. You don't actually have to. You can opt out. So if I have a bunch of 15-year property, I could write off 80% right now, and I don't lose the rest. I just spread it out over the 15 years. Or I could say, nah, I'll write it off over 15 years. I've still accelerated my depreciation over 15 instead of 27 and a half. Or my 5-year property, I may say, you know what, I don't want a huge deduction there. Just write it off over 5 years. Or my 7-year property, same thing. I get to decide as the taxpayer how I want to write those things off and how quickly I want to write them off, depending on, like, I'll have 2 or 3 different options just off of that.
And if not, you can always write off everything when you exit the property too. That option is there as well. That's what you're saying earlier.
Yeah, if you forgot to, or you didn't know that cost seg was available, you may still want to look and see whether it's beneficial for you. You don't have to, like, let's say you did a study, and most studies are free. Like working with somebody that knows what they're doing, they've done a million of these things, and so they're looking at it going, all right, so you sold a property. What'd you buy it for? What's the address? Let's see whether we've done, like, they're looking at that type of property in that particular area. They're going to make assumptions, and they're going to look at it, and they're going to be able to tell you, hey, Vinky, I look at this property, and I think that we could reclassify 25% of the improvement value. The improvement value is $2 million. So there's about 500,000, and you owned it for 7 or 8 years. Here's what we think it would do to your recapture. Hey, it's going to save you, let's say $62,000 to reclassify these things. And it's going to cost you $15,000 for us to go in there. That's usually what they're doing. They're giving you that kind of option. And then they say, hey, if I'm going to do the report, you're supposed to attach to the tax return when you do file. But they're going to say, hey, I need this report done. I need to have access to the property. So as long as they're willing to give you access to the property, you should be fine.
Oh, great. Thank you. We are out of time. Actually, we are over time. It's such an interesting topic, and I don't even get to your 4 legs of the stool. So I think I'm going to have you back. Let's record another episode and we continuation to this, whatever we talked today. So before you go, can you share your contact information? How can people reach out to you?
Yeah, the easiest thing is, and as you've learned, Vinky, is just type my name in and type in YouTube, Toby Mathis YouTube, and you'll find me out there.
That's true. Toby is a rock star on YouTube. He's the first one that I saw this morning on YouTube. I started my day with Toby today.
Just come in and subscribe to the channel. It's free, and then probably put 3 or 4.
That's good. That's good. Thanks, Toby. So I'll look forward to another recording with you soon.
You got it.